Chit Chat Money is brought to you by Interactive Brokers. Designed for active traders and sophisticated investors, Interactive Brokers offers trading assets in 150 markets with 27 different currencies. Interactive Brokers also charges USD margin loan rates from 5.83% to 6.83%. They've also got the ability to trade stocks, bonds, futures, options, commodities, and more, all from a single unified platform. Brett and I use Interactive Brokers ourselves, and I honestly have to say that if you spend a considerable amount of time managing your investments, if you're spanning the globe looking for new stocks, I highly recommend using Interactive Brokers as your platform of choice. Restrictions apply, but for more information, visit ibkr.com, member SIPC, open an account with IBKR today.
Okay, welcome to Chit Chat Money. My name is Brett Schaefer, and today we have another quality interview for the listeners. We are talking RH as we continue in our December luxury theme with Paul Cerro, founder of Cedar Grove Capital Management. We'll have the link to Paul's Substack in the show notes. We can read more about RH and all the stuff he is following, including in the small and medium-sized business investing world. We've had him on the show before, so if you like this one, go search your podcast player for other interviews from Paul on Chit Chat Money. We talk RH's business model, it's how it shifted, its international expansion. We talk all the stuff that they're trying to get into with restaurants, residential stuff, the RH private jets and the yachts, as well as how they are trying to climb the luxury mountain within home good furnishing. So let's not ramble on too much and spoil the whole thing. Here is our interview with Paul Cerro on RH.
Welcome to Chit Chat Money. On this show, hosts Ryan Henderson and Brett Schaefer interview industry experts and riff on the world of investing. As a quick reminder, Chit Chat Money is a CCM Media Group podcast. Anything discussed on Chit Chat Money by Ryan, Brett, or any other podcast guest is not formal advice or recommendation. Now please enjoy this episode.
Welcome in. Today we are kicking off, or actually this will be the second interview. So we're chugging along in our luxury theme month and we're talking RH, which for anyone that's followed them is trying to make the transition to luxury. And we have a recurring guest, Paul Cerro on the show, founder of Cedar Grove Capital Management. And if you don't know, someone who has been writing and exploring and has bought one so far, if I'm correct, a small business in, I don't know the exact details of the structure, but maybe you could talk about it more. But yeah, how have things been? And how is it in small business land, trying to buy, look for things to buy?
Yeah, no, I think 2023 has been also thanks for having me, but 2023 has been a very interesting year for a lot of reasons, both on the public side and private side. Public side, as you can imagine, everybody's going on quite a roller coaster this year, as we did last year. And even on the small business side, I mean, it's noisy. There's a lot of people who say things are fine, a lot of people who say things are not fine. There's, you keep hearing about bankruptcies, you keep hearing about all these people having difficulties. So I think when the small businesses start becoming a little bit more pronounced in their opinions and their thoughts, that's when you should really start paying attention. I think it's kind of happening now.
Yeah. Okay. And how long have you owned this small business? I believe it's the pet one. We've talked about it before. Mm-hmm. And I guess how has it been? I'm very curious. Like, how is it running a small business?
Yeah, it's a little over a year, and it is a learning curve, especially when you go from never owning one to owning one. You learn a lot about like the accounting side, legal side, payroll, managing employees, customer. You're in it, right? Like you're the guy. So it's been very knowledgeable, but I'm not going to say it's without its ups and downs. But at the end of the day, hopefully that if you did your homework right, you are able to at least continue to have it grow, have it continue to thrive, etc. If you find out that it's not for you, hopefully there's a way that you can pass it on to the next person or something. Like there's at least in small business world, there's just a lot that can go on. It's almost kind of like Murphy's Law, but I've learned a lot in the last year. That's for sure.
Yeah, it seemed like you decided to, on purpose, jump right into the deep end of the pool. And what's interesting with the small businesses, and we'll get to RH in a second, is that I think it was you that brought up the data point of how there may be over 1 million or just a large amount of small businesses that are owned by people that are likely, boomers or older Generation X that are going to have to either sell or pass it on eventually. And there's just going to be so much liquidity of, right, just so much supply trying to come into the market. So it seems like a very interesting thing to be in and trying to go out for the next 5 to 10 years. But we're talking RH. You still are in the public markets as well. You followed RH for a long time. How were you introduced to them? And, what's been your journey following the company?
Yeah, I mean, I've actually followed RH since I was in banking. RH was a client. And actually, I think one of the last things I worked on prior to leaving was, I think they were doing a convertible debt raise. And I think this was this in 2019, 2018? Can't remember. And that's when their stock, I think, was trading at like, I actually have to look this up actually, because I think it was like $80 a share back then. Let's see. Yeah, it was about like, oh, yeah, 80, $90 a share. So if you've been following it along since then, I mean, it more than quintupled at the top. And then, just like a lot of consumer stocks came back to reality. But no, I've been very familiar with it. Over the last, 5-6 years, I've also seen the transition of, its galleries, et cetera, and also the very outspoken opinions of Gary.
And that's the for listeners, that is the CEO, who we'll probably talk about a lot. He is 99% of investing conference calls are extremely boring, but if you follow RH, luckily they are the 1% that is not boring. He is not afraid to speak his mind. Yeah,
he rambles a lot, but he's also very real. But no, so I've been playing it for a very long time. So it's been close to me for a while now.
All right. And we'll talk about at the end what either attracts you or doesn't attract you to this business and the stock. But for people that don't know, and I guess they did change their name from Restoration Hardware to RH. So for anyone, this is the same company. Restoration Hardware is RH. What is RH's business model? And this is one we could probably talk on for a half hour with all the different strategy shifts that they're going through. But how has the strategy shifted for them in recent years?
Yeah. So RH, they basically sell it's home goods and furnishings, right? And furniture. So I know there's a lot of people who are have been in that market or currently in that market. It's premium stuff, right? They have very high quality like bathroom towels, which like I have, and I sell a very high end furniture and home furnishings. If you want to kind of put them in a bracket, it's kind of like you have at the bottom of it as far as like kind of nice premium is like your Crate and Barrels, your West Elms, your Williams Sonomas, even though it's kind of more like kitchen-y, Herman Miller, I guess. But then you keep kind of going up, and you got like Ethan Allen and RH is up there because everyone kept like commenting on their, who's going to buying a $15,000 couch? Like that's kind of what RH is. That's kind of what they sell, and they sell them in these galleries. And these galleries are basically what you would go. It's almost like a showroom, right? You go in there, kind of see the layouts of like what your living room could look like, what your bathroom could look like, what your dining room, bedroom, etc. Right? And before these showrooms were very much like they're like kind of like on the smaller end. They weren't really that well thought out, etc. And Gary kind of transitioned these showrooms into these galleries, which were like very, very, like you walk in there, you're just like, this is a store, right? You actually think you're walking into like a legitimate, like rich person's place, right? And they also incorporated it because they wanted to be more experiential. So it's not just you just going in and saying, "Hey, I'm looking for a dresser," and like that, you go to a Wayfair, you go outside our Wayfair, you go to an IKEA, and you just look at the dressers. This is like you go in there, you go shop, and then you can also go eat, right? So they have like restaurants, and it's a whole ordeal, right? Because it wants to sell people on an experience of what you're basically paying a high price for, right? Um, and getting it done that way. And they also have like their own little catalog, which if anyone has ever received an RH catalog, it is a very thick book of everything that's going to be coming out that season. So you can order, etc. They're also online. But their bread and butter are really these galleries. And they lure people in from just the experience of going there and trying things out, but then also showing to them like, hey, like there's a reason why you're paying $15,000 for this couch. And that's kind of like what their simplistic business model is.
Now, do you think the change from basically back in the day, they did less of this catering stuff. Do you think the change to say catering to the 1%, you might call them, and having this stuff where they want people spending multiple hours in the gallery, do you think they're trying to take that as a lesson from the luxury companies like an Hermes or something like that and trying to apply that to attract the same sort of customer base? Is that where they're coming from here, or is it from maybe a different lens?
So here's the thing, and this is very subjective. There are a lot of people who come from different income brackets, right? And historically, right, and this is no offense to them, there are people of the lower to middle income brackets that do enjoy quality goods because they know that if they pay for a quality piece of work, whether it be a handbag, whether it be a couch, whether it be a kitchen table, like whatever you want to call it, that they're going to be getting their money's worth, right? This is exactly why people will buy a Chanel bag or a LVMH bag. They'll go to the West Elms and pay $3,000-4,000 for a couch because they know it's of high quality. It's going to last a while. And then there's also the people who are of those income brackets that want to look as if they are rich because they have said thing. This is also why they spend money at Chanel, at LVMH, at Gucci, West Elm, like whatever, right? Like, because they have like that one piece that they can talk about, like that I own it. RH is, and again, this is very subjective, they have home furnishings for a lot of people who make different kinds of amounts of money, right? So you can still get a towel set for like, when I say towel sets, like a towel and like a washcloth, like $100, right? It's definitely not cheap, but if you can't afford it. And then they also have like the top of the spectrum too, which is like, who has money to spend $15,000 on the couch? Not that many people, right? So I think it's them being able to showcase that RH offers a lot of different products at a lot of different price points. They're by no means cheap. I don't want to downplay that at all. They're by no means cheap. But the products that they offer and they sell are of very high quality. They can also be custom as well, made to order. But you're gonna need a chunk of change to buy them, right? And that's kind of why whenever you spoke about RH, not you, but people who spoke about RH, they would always kind of relate it to like the high net worth individuals. So we're talking about like 1 million plus, because they would be the ones to buy the bigger, nicer homes that would want to then fill it with bigger and nicer quality furnishings, right? So there's kind of always like a comparison to those two. And then you have other people too who would again just want like that one piece from them, or the bathroom sets, or like the kitchenware. There's a lot of different things. So it's not that they're trying to attract other people, but they're just trying to share. They're trying to, like, again, with other luxury brands, prove that, hey, we are of top quality. We are a top quality company selling top quality goods. And yeah, while it skews traditionally more towards a higher income person, there are some things that people will still want to shell out money for because RH it's a valuable thing to talk about. So that's kind of like where I believe things are, but it's not necessarily like they're trying to move like uptrend or downtrend. It's just like, we make good stuff. Whoever can afford it is going to buy it.
Okay. And we're going to come back to, because the company has talked about a lot and a lot of investors talk about them with their famous quote of climbing the luxury mountain. We'll get back to that later, but I want to talk about the core business. Probably, I don't want to call it the legacy business, but it's the one that they've been operating for many years, and it's home goods. So it can get impacted by the housing cycle. And as we've known for the last few years, it has been probably the wildest housing cycle. We've had people freezing in these 3% to 4% mortgages. And I know you had a quote here in I think it was your most recent update on RH, where you said Gary, the CEO, has been calling for this, this storm of the year to take place in 2022 for housing, and he hasn't downplayed any of it. So that's just some context for how have they been impacted by the housing cycle, or maybe how do you think they've been impacted by the housing cycle? Is it depressing their financials, say, over the last few quarters?
Yeah, I think it's a very hot topic because in March of 2022, I remember this because when Gary was on his earnings call, everybody was listening because he went off on that call and basically said like, hey, if you don't think we're in a recession, you're out of your mind. Like things are going down the tubes, like brace yourself because it's going to be a wild ride. Everyone's like, yeah, half of the people saying like, well, he must know what he's talking about because he's the CEO. And the other half saying he's just blowing smoke. There's no way it's going to happen. But it was interesting because he doesn't hold anything back. He kind of calls it as he sees it. However, fast forward to now, right? We've almost had almost 2 years since that call. He has basically said like, hey, housing's slowing down. Things are getting more expensive. Our once dominant position in the space is kind of like not deteriorating, but it is seeing impact. And it's not an easy one because when you think about the consumer, it's not black and white, unfortunately. Everybody thinks it is, but it's really not. And for him to say like housing is going to be a big role in the impact of his business, it's a very fair assumption, right? Because you can be in the camp of if housing's taking a hit, RH is taking a hit because RH is the one who is supplying those people with the goods to put in their house. And it's tough because with housing kept going up and up and up, and then rates kept going up and up. Debt service mortgages kept going up. The dollars to buy the house kept going up. So when you think about what cash you have left to do anything with, it's becoming less and less for all the discretionary things that you might spend on it. Historically, again, being those high net worth individuals who are paying 1 million plus for a home. And, even if it's $50,000 more that they're paying for, it's like that's $50,000 less that they could be spending to furnish their home, or to replace the stuff that's already in there. Right. There's a huge shift. So you have one camp, which is what I was a part of, am a part of, was, hey, there's less share of a wallet to go around because the housing people who would then be spending on this can't really spend as much as they can. But then you have another team on the other side, which is a fair assumption. Again, it's very subjective. At least as of now, I believe that their buyers just aren't picking the right products to sell. Because if you look at the Williams Sonomas of the world and you look at other furniture companies, it's like they're doing fine, or they're doing okay. Like they're weathering the storm. So it really depends on what kind of, maybe it's a mix of both, right? But when you think about historically how well RH has executed even before COVID, it's tough to say like they don't know what they're doing in the core business. But I would be amiss to say that consumers aren't feeling a pinch when it comes to what they sell, especially if they're high net worth individuals. People are going to say like, oh, well, if the rich aren't spending, things must be bad. Well, it's like, again, like if you think about what happened in COVID threw everything off. Like take the whole playbook, throw it out. Because if you already bought all your furnishings in 2020, 2021, what's the replacement cycle on that? Years? You're not going to keep buying it, right? You need new flow, and that new flow is being hindered by everything that's happened with inflation, home prices, mortgages, yields, rates. So it's a lot of things. And I think it's just not the best to kind of like put it on one thing. But that's what Gary's been saying. He's like, hey, it's tough out there, and I think we're going to feel it, but we'll get through it.
Chit Chat Money is brought to you by Interactive Brokers. Designed for active traders and sophisticated investors, Interactive Brokers offers trading assets in 150 markets with 27 different currencies. Interactive Brokers also charges USD margin loan rates from 5.83% to 6.83%. They've also got the ability to trade stocks, bonds, futures, options, commodities, and more, all from a single unified platform. Brett and I use Interactive Brokers ourselves, and I honestly have to say that if you spend a considerable amount of time managing your investments, if you're spanning the globe looking for new stocks, I highly recommend using Interactive Brokers as your platform of choice. Restrictions apply, but for more information, visit ibkr.com, member SIPC, open an account with IBKR today.
Yeah, and it seems like there has been a giant slowdown in spending for physical consumer discretionary items, but a lot of it did shift to entertainment and experiences for the time being, which makes sense because of, like you said, the pandemic, the bullwhip effect from that. It seems like they're getting affected. One follow-up I have for this one, and maybe this is more of a general one before we move on to kind of their big ambitious things. Does the core business still have room to grow in the United States? Because they reference, and I should have had this exact number, you might know it. I think they say something about $5 to $6 billion in North America, when that's definitely smaller than, or a bit larger than where they are today.
Yeah, no, you're right. Because their the new galleries, right? The new showrooms that they have, right? I keep using showrooms and everybody understands when I say galleries, but that's what they call our galleries. They're just so massive in scale. It's not like you're trying to pop up a McDonald's every couple of miles off the highway because you're trying to grow with scale, right? You go to an RH destination, an RH gallery, because that is the only place where you can get it and you want to see it, right? If you think about like urban cities, like I live in New York City, right? And there's a very, very nice RH gallery in the meatpacking district in Chelsea. It's massive, multiple floors, has a restaurant, etc. And you're not trying to flood the market, but there's definitely white space in America to be able to keep building out these galleries and in these cities that have been attracting, especially when you talk about migration of tech bros and everybody else who has developed wealth over the last couple of years. Like there could be more in Florida with like Miami and everybody moving from New York to Miami, right? There should be more in like Austin or Houston, potentially in California or Seattle. The one that I know we spoke about it before we started recording, but there's definitely white space there. But I don't see why there couldn't be more design galleries. And when you also think about it too, while it will take CapEx to build out everything, like that also kind of helps with like logistics as well, because you could kind of like move pieces around a little bit easier if you have stores more in a network within around the country, right? So yeah, they did quote to $5 to $6 billion in just endorsements in North America, but I don't think it's not possible for that to happen. I think it's very much possible, but again, there's execution risk with that, and also seeing how the economy plays out. But that is what they quoted, and I do think it's something that is not far-fetched.
So what are they doing? I guess this is part of the kind of ambitious growth strategy. What are they doing to change? Like, what are they doing to get to that $5 to $6 billion in revenue? Because from that, I don't follow the company that closely. Like, what's different between them now versus say 2018 that's going to get them to that $5-6 billion range?
Well, yes, historically, like I mentioned it in the past, so the design galleries were much, much smaller. I think they were like sub 10,000 square feet. If you think about it, 10,000 square feet is still pretty big, especially when the average home is, I think, like 2,500 or 3,000 square feet. You basically have like 3 or 4 of those in their old design galleries. However, when the new updated refreshed ones, it's multiples of that, right? So if you had a 10,000 square foot legacy gallery, you're now dealing with 30, 40, 50, even sometimes 60,000 square feet. I'm talking, these things are massive. But it's not like some type of warehouse build. Because for people who aren't familiar, I don't want them to think it's like you walk into, like, again, an IKEA and there's just built furniture everywhere and like, hey, take your pick and then get an employee to like help you put in your cart. Like, that's not how it works. It's a very, very experience-driven service. So when you think about how to help a consumer spend more money, it's because you make them want to be able to spend that money. You don't make it a hassle. You make it very much like, oh, I want to own this. So when you think about how they can get the incremental sales lift, it's kind of already proven. Bigger stores result in more sales. Again, it's strategically located. I'm not going to say it's like a foolproof system, but bigger stores can lead to bigger sales because you can fit more stuff in there. You can show off more product. You can help a customer go for a couch, but then, like, why not just complete the couch with a coffee table? Why not complete the coffee table with end tables? Why not complete them with lamps? Why not, you just keep tacking on things because you have so much to offer them, right? And I've been to Crate and Barrels. We got our couch from Crate and Barrel, and like, while it's nice, it is very limited. It's like one floor. It's like maybe 1,000 square feet. So when you talk about a sales lift, you have bigger galleries in general to be able to offer customers more for their, I guess, new purchase. But then you also have, again, more unit growth. So that's physical galleries opening up and contributing more to the top line. And if you're able to sell more out of each store, right, then your four-wall EBITDA is going to be going up, right? So your unit economics goes up, as long as people are spending, right? So you have a really nice effect here between the unit growth and the ability to upsell customers when you're there. I think that kind of plays hand in hand very nicely with growing top line. And from there, looking top down, it's just a function of being able to execute well on the profits. Making sure like labor doesn't get too expensive, et cetera. But that's kind of how that's a two-pronged approach, right? It's just being able to sell more per store and then being able to grow stores.
Makes sense. And another way for them to expand, which they have quoted some perhaps more ambitious numbers, is international expansion. Now, when I read some people that are a bit more maybe bearish on this part, they say, hey, American brands have trouble going to Europe, which is kind of their big first target market here. But when I read your update, you said that, quote, international expansion is not where investors need to get wary. Why do you believe that? Why they're setting these up in London, I believe. Maybe it's not London. Paris, Madrid. Why do you think these can have success? What's their strategy here?
So being in the consumer space, I think you're not wrong. There's a lot of people who say like, yeah, when an American brand goes to overseas, kind of like it's not received as well because it's an American brand, right? Usually American brands are very mass market. They're very cheap. They are not of high quality, right? It's like when H&M moved from Europe to America, great product market fit. People want cheap clothes. If you're talking about like if an Allbirds moved to Europe, yeah, it's very different because if you think about Europe, they have very high quality stuff for footwear. Allbirds might be revolutionized the tech bro lounge footwear here, but that does not necessarily mean it's going to fit in Europe. What's interesting though, and this is why I said you don't need to be as concerned about it, is because it's furnishings, right? There's no label on the furnishings that says this is RH, right? They're not like plastering everything that says RH. It's home furnishings. It is this quality stuff that if you like it, you will buy it, right? So when you think about the market in general, overseas, internationally, it's very fragmented, right? You have a lot of smaller companies, mom and pops, who are making the furniture and selling it. So it's a very highly fragmented place. So when you have RH coming in, who's like, hey, we sell high quality stuff, people who have money will still always flock to products that they can afford, right? If it's high quality stuff, you're going to go there. So when you think about RH, bringing in a new design gallery to the UK, to France, to Germany, and there's a whole list of countries where they plan to open up stores. It's not like they're trying to flood the market with like, all right, we got to get everybody in here. It's like, no, it's like, you got money, we're going to build you the experience here, and you still have to come to us, right? And we're going to make sure you have a great experience. We'll make sure you spend money here because you can afford it, and you appreciate high quality stuff. You don't have to go to like 8 different people in order to get furnishings for your home. You can literally just come to RH and we'll take care of it. And that's why they're spending buku bucks building this out, because they're trying to penetrate that market. So that's why I was saying, like, don't have to be too concerned, because it's still very high quality stuff who's only going to be attracted by people who appreciate high quality goods. And it's not like they're just trying to flood the market. It's going to be a slow burn internationally. It will require capex, just like every other company in existence has ever expanded internationally. I'm not downplaying that, but it's not one where I don't believe that there are not going to be people who are spending money.
Yeah, and there's quite a few wealthy people in Europe as well. Now,
yeah, just
the
few.
one thing that, yeah, there, I guess the thing that maybe investors get the most concerned about when I talk, or at least read what they're saying, is all these adjacent things. Like the international expansion, it's a pretty clear path, but now they got the, what do they call it? The RH private jets, the RH yacht. They have this residential thing / hotel thing. I'm not exactly sure. You can kind of explain. People get very confused about this. What's their strategy here? And does it connect to kind of the new, maybe not new, but them trying to build themselves as the home goods luxury brand, and having these galleries with the restaurants and the stuff like that? I mean, people get very nervous. I mean, didn't they just buy the wine, the acreage in California?
Napa Valley. Yeah,
yeah,
Napa
exactly.
Valley. Yeah.
So you got winery, you got restaurants, you got the private jet, you got the yacht, you got these residential / travel things. What is their strategy here? Do you think it's too ambitious? Because a lot of people kind of they get concerned when they're doing all these things at once.
Yeah. So I know I mentioned a few times the experience that they've been able to create within these galleries has proven very fruitful for their business. Like, they understand that it works, right? So they're just trying to take it up one notch. And again, I'm not as bullish on this part. I label them as controlled call options, as long as they stay controlled, right? As long as Gary doesn't start like doubling down, tripling down, quadrupling down on the growth capex here to build out these ideas, the call option could play out. So what to recap people who are listening, core business is experiential galleries, to help people buy goods and home furnishings. The call options that he's doing here is he's taking that experience up a notch. And with these experiences, he's talking about, hosting luxury yachts and luxury hotels and luxury residences. The estate, I guess, that they just opened up in England. I think it's like 50 acres, 50, 60 acres. Might be more than that, I forget. But it's like massive, right? And you go there because you want to be able to like visit it, stay there, spend money, pick up a few things, have it shipped back to wherever you are, etc. Right? So what I believe he's doing, and I know you guys have followed Airbnb before. I mean, Airbnb is just like, capitalizing on the whole like trend of traveling and potentially experiences in different countries and whatever, right? Beating out hotels. There is a subsect of individuals who have buku bucks that want to spend buku bucks on an experience, an experiential stay in multiple places around the world. And I think in my notes, I think I have it where there are people who pay upwards of $13,000 a night at some of these like crazy like villas and stuff like that because they can, right? And if you think about Gary and his ambition of making RH bigger than just home furnishings and capturing more share of the wallet of high net worth individuals, he wants to capture their ability to kind of, I don't want to say lure, but attract those individuals to be like, hey, even if you don't want home furnishings by us, we can still deliver on a very well thought out, high quality experience that you can pay for, right? It's not like people who are contemplating staying at the Marriott versus a Holiday Inn, right? These are people who like, they roll up in the Rolls Royce they just picked him up in the from the airport and they drove him out to the countryside or something, like, like it's that type of service. And he's trying to capitalize on that subsect of individuals who are willing to spend and who want to spend. The big question mark here is if it will actually work out. Will those consumers actually perceive RH to be the one that can deliver on that? Is it a far-fetched idea? Will it pay off? It's very expensive because it's not like you're designing a new product and seeing if someone buys it. You have to buy an estate and you have to renovate it and hire people and train people and furnish it and go to all of the it's not cheap, right? That's kind of why I labeled it as a control call option, because there is dollars going to it, but it's not like runaway growth here where people are just like lighting cash on fire in the name of like, sparking something like it's a tech. It's not really like that. So that's kind of why I labeled it as like an inflection point, because RH it's not necessarily pivoting its model, right? It's just bolting on a new part of it to its business. And that's kind of why you either have to decide, all right, if I loved the core business and only the core business, do I want to stick around for the next iteration of RH under Gary? Or you know what, I've had a great ride. I'm gonna call it out because I only want the core business, and that's kind of where things are. But there are lots of spend going to building the next level of luxury experience under RH.
Have they given out any data about how successful these have been so far, or are we still in the very early stages? We won't know yet.
Oh, it's still very soon. And considering what you could be spending money on, like for instance, if you have like chartered planes, right? Like, okay, there's Blade exists for a reason, right? There's people who use Blade. If you want to talk about the yachts, right? We don't know, because I certainly can't afford it. I don't know about you, but there are plenty of people who knows a guy or knows a company who charters private yachts, right? So like, why not be able to do that all under RH? I'm not saying it's the smartest idea. I'm saying I understand where he's coming from, but that's kind of where he's trying to like strategically place money, see how it rolls out, and see how that experience, because maybe the planes make sense, maybe they don't make sense, maybe the yacht makes sense, maybe it doesn't, like maybe these residences where people will actually pay RH to build out these residences and like manage it, etc., will pay off. Like we don't know. And that's why I think people are scared, because it's something pretty new for the company. And since we don't have a track record of it, we can't really place a high confidence interval to it. All we know is that historically, RH has done very well with integrating experiences within its design galleries. And that's kind of what everybody's running off of.
Okay. And those historical ones can be like the restaurants and stuff like that have done quite well.
Yeah. I mean, that's basically all you really have to go off of. Okay. So if you can kind of intertwine that into a villa or an estate or, on a boat, it could pay off. And that's why I label them as call options.
Right. Okay. And now back to the core business. Maybe some people disagree about this, but there's a lot of people. The consensus seems to be that there has never been a scaled luxury company for home goods and furniture. Why do you think that is? Because there isn't like the Hermes or the Louis Vuitton or the Rolex for home goods. Can RH be that? Can they climb into this luxury space, as they call it, the cliche, the luxury mountain? Is that achievable? And maybe like, how long could it take? How are they telling kind of this luxury story? Do you think it's being successful with their target customers?
It's going to be a slow burn. If they can get to it, I think it's going to be a slow burn. I'm not expecting it to happen anywhere in the short term. How old's Hermes? 200 years old? A little over 200 years, something like that.
They got quite the story to tell. Yeah.
Yeah. Hermes didn't become Hermes in 10 years, in 20 years, in 30 years. Hermes became Hermes because it's lasted a while. It's fitted royalty in Europe. It's done a lot, right? And it's like fine wine, right? It gets more and more expensive and tastes better the longer it exists, right? And that's why Hermes can charge $50,000 plus for a single Birkin bag, right? And then it'll resale for like double that. When you look at, and I'm actually glad you asked this question because I think I've heard of other people's comments about it. Did you say you had Sleepwell on already, or you were planning on talking to Sleepwell?
He will be on the week before, and we didn't cover RH too much, but yeah.
No, but because I know he covers luxury. I know that. He's had a few thoughts on luxury.
Yeah, he'll recording it different, but his will be on. It's already recorded for the listeners. It'll be the one the week before this comes out. So yeah.
Okay, it's on Broadbase luxury, right? Or is that Leandro?
That they were both on at the same time.
Oh, okay.
Yeah. So we both talked. Yeah.
So I've chatted with Leandro about it too. So luxury goods. Also, it depends on what you define as luxury, right? Like historically, luxury has been like very high quality, exclusive stuff, right? Like the only people who can get them are the people who could afford them, right? Like people who could afford them, that bucket is very small. So when you talk about luxury, up this luxury mountain, it's, in my opinion, it's still high quality goods, and it's still attracting the people that you want to attract to buy it, which is predominantly the rich people, right? Rich individuals. However, when they make a comment about, it's not quite luxury, that I just have to disagree with that because people are so fixated on the Hermeses, LVMH, the Gucci's, the Pradas of the world, right? Which they are luxury. They are luxury brands. However, when you talk about scale, like small leather goods is so much easier to scale than furnishings. It just is, right? Like, don't get me wrong, you will still see pieces from LVMH. Like you'll see, I think they come up with like a boxing bag that has LVMH stamped everywhere on the leather. That's like $4,000 or $5,000. Like you're not moving that en masse, but there's going to be some egotistical guy who wants to have some boxing bag with LVMH hanging from the ceiling. When you talk about the consumers paying for it, like, yeah, more consumers are going to be paying for an $8,000 satchel, 1, 2, 3, 4 times throughout their life because they want to have the different styles of bags for different reasons, for different purposes, right? Same thing with wallets, same things with for men's briefcases, same thing for their perfumes and like glassware, plateware, like all that kind of stuff, right? That they all make, right? Because it's all small stuff where two things: the replacement cycle can be a lot shorter, but then also you can kind of build out your own personal closet or apartment or home or whatever more frequently with those smaller goods because you need to just get more of it to have optionality. No one is going to be buying a $15,000. I'm going to stop saying 15,000 because I don't want people to think I'm like skewing it. $5,000 to $10,000 couch as often, because when you buy that one $5,000, $10,000 couch, it's going to be there for years, right? You're not going to keep switching it out. Like, all right, honey, let's go to the garage and like go get the brown leather couch instead of the suede one. Like nobody does that, right? I mean, I'm sure there is somebody, but in scale, nobody does that. So when you talk about like why hasn't a home goods company scaled as much, it's because the ability for them to is not nearly as abundant as the other luxury brands can and have done. I'm not saying there's anything wrong with it, but it's just you're comparing apples to oranges, right? They're still a part of the same like category, but what you're trying to sell are just two dramatically different things. So that's kind of why I believe that calling or trying to say like they're not necessarily luxury. I don't really know about that. I mean, I think it's also because like people don't associate luxury with an American brand. I think Americans think of luxury as in, the Europeans when they were still kings and queens of the world, and like they fought over, religion and territory, like that kind of thing, right? Versus an American brand that's like, hey, yeah, we popped up like not that long ago. I think there's that level of aspect and misconception, but that's why I don't think it's been done before. It doesn't never say never, but that's why I also think it's going to be a slow burn as long as they can execute well. And so far, if their track record is anything of it when it comes to the redesigning of the galleries, I don't see why they couldn't be that company at scale. It was never made for mass market. It's never intended to be for mass market.
Yeah. So what you're saying is if they technically aren't true luxury, it doesn't mean the business can't succeed over the, you know what I mean? Is that kind of what you're summing up here? Like, even if there's holes in their idea that this is like a luxury brand and whether it's a little different because it's home goods compared to the traditional ones.
Yeah, because I think
the stock's going to not work. Yeah.
The track record of luxury favors those that have been around for a while, which is, again, the small goods players, because it works. It works very, very well. And so when people start thinking like, well, they aren't really going into furnishings that much, so is that because they know something? It's like, no, because they have a model that works, and they also weren't founded on that. RH was founded on the furnishings model, and they've had to iterate, which has been successful to an extent. So that's why I say like comparing apples and oranges, because it's like same but different, you know. And again, depending on who you ask, some people are going to say that's not right. You're going to say like, oh yeah, I can kind of see that. So it's like I said, it's a very subjective topic. But that's kind of where my thoughts are on it. But yeah.
All right, let's move into the CEO mentioned before, Gary Friedman. He is a unique character. I want to talk about, your thoughts on the buyback, balance sheet, and kind of his capital allocation principles in general.
Yeah, so he's a firecracker. He, like I said before, he rambles a lot on his calls. Like if you can cut down his calls by like 75%, you'd still probably be there for like an hour, because he just talks so much. However, he is an ambitious guy. Historically speaking, the people who have been able to deliver spectacular results in things, in projects, in companies, in ideas or whatever, usually come from people who have thought in a very crazy kind of way, right? He's one of them. He's very unorthodox. He's very direct. He's very loud. He's very opinionated. I mean, when you're talking about like design-oriented goods, you kind of have to be, right? So that's his personality. And when I mentioned at the beginning of this call, when I first got introduced to RH, it was because we were doing a convertible debt raise for them, right? They're going to be paying a 0% coupon, and I believe at the time, the exercise price to convert was, I think, like 50% higher than where the stock was trading at. And there were people who were like, I'll fund that, because they were like so optimistic about the execution of RH, which if you look at the chart, yeah, it really did happen. So when you think about his capital allocation strategy, if I'm talking pre-COVID, you had the smart strategy of doing convertible debt, with high exercise prices that people were willing to pay for, or sorry,
and
people were willing to fund.
Taking the share count down by half, or you might be getting to that.
Yeah, that was late. That's late. That's after COVID. That's like COVID onwards. Okay. And his strategy to spend money to build out these bigger galleries, this new experiential stuff. So that's pre-COVID. Did well. Then we talk about COVID. Granted, it messed everything up because you had people stuck in their homes, flush with cash, wanted to buy the nice things, right? The nice stuff of the world, right? They didn't want to go to Wayfair. They were going to go to RH, and they did. However, they had a buyback authorization of a few $1 billion, which at certain points was about like half their market cap, depending on kind of like where you looked at it. And the most recent one is when they bought back. I think they left. Was it like 1.25 or $1.3 billion in cash in the remaining authorization to purchase stock? I think it was about, oh man, what was it? It was like over 25%, something like that. It was wild. It was big, right? And that kind of kept it from capitulating. A lot of people would argue that his most recent capital allocation strategy of his share buybacks was a little bit premature, especially if you don't think the economy is going to recover for his company just yet. The stock could go down further, and he could have bought cheaper, right? It's always these could haves. And honestly, I'm kind of in that camp. He could have, right? But with the recent buyback authorization, I think he did what he thought was right at the time. It might not have been perfect. I'm not trying to say it was. And but then you also have him saying that the company's going to be spending, a few $100 million more to build out these wild dreams that you and I just talked about, just in the hopes that it's going to, invigorate new type of growth within the company. So it's tough because I think there's a lot of uncharted waters here that need to be navigated. Um, I I do think there probably might need to be some checks and balances put in place with him to make sure he doesn't go off the deep end and take everybody down with him. But I'm not going to sit here and pretend that his crazy ideas didn't get RH to where it was, before this whole inflation debacle. Like he led that. That's kind of why I'm still backing him.
So what does their capital structure look like? Because I think some people worry about, taking on a bunch of debt and then buying back stock, right? How has it turned out?
Yeah. So, I mean, there's a lot of debt. I think it's probably about like half the market cap right now. Something like that. I haven't checked it recently. I think it's roughly give or take. And yeah, something that is floating. So it can get expensive. But when you think about the rate of return here, if which is not like he didn't have to get sign off on, he still needed to get sign off on it. Buying back the shares at the prices that he bought them at, which is kind of like around here. I think that around here and up, I think it's like average is like 325, 330, something like that. As of right now, it looks like it was a bad idea, as of now. However, he also owns a large stake of shares in the company. And one thing I definitely want to point out when people talk about insider ownership and the vision of the CEO and kind of like where they're going, right? You have a lot of CEOs who have done very well with stock-based comp, and they liquidate their positions. I mean, not liquidate, but they draw down on their positions because like, hey, I'm gonna go ahead and take some chips off the table. When RH was selling at above $700 a share, he really didn't sell any, and like that was an all-time high for RH. He's like I didn't want to sell anything there because I knew it was going to be worth more than that. I still think it's going to be worth more than that. So you have a CEO who's like, my money's where my mouth is. Yeah, don't get me wrong. He's sold shares to like pay for the options and stuff like that, but like he's still in it. He's got skin in the game, and he's been on a wild roller coaster of it. Like I said before it over quintupling, and then also it getting cut by half, and some points I think it was like 60%. No, yeah, something like that. So you got a guy who's in it to win it, and he puts his money where his mouth is, and I gotta respect that because he could have easily taken a lot off the table, and he didn't. So that's why I think he truly believes that his new capital allocation strategy of putting into these new growth oriented projects will yield him higher than what he has already paid out, or sorry, already bought back in shares, and what he quote unquote gave up 2 years ago, in the sense of what he could have realized as far as gains.
Okay, as we close things out, what are your thoughts on the valuation today? For listeners, just in case you're listening at a different time, we're at about $288 a share as of this recording. And are you buying? I know what's nice about having you on is you can be open about what you're doing. So are you buying shares, at these levels? Why or why not?
Yeah, I mean, we still held a position at the end of our Q3 letter. Disclaimer, I still have it. Am I sizing up? Like, no. Just because strategy's changed a bit as far as how the fund goes. However, the point still stands that I'm saying is like the inflection is there, and you just have to decide if you're going to be going for the ride. It's not going to be an easy one. It's going to be very bumpy. But if you either believe in the vision that can come to fruition, it could be very rewarding, or it could be very painful in the sense that it doesn't work out, and the company has spent a lot of money to do so. I'm still optimistic because they still generate plenty sizable free cash flow, even after paying off all the debt. Paying off the service coverage, and that's kind of where I see it, big picture. However, there are interesting takes that which piggyback off of what you said, like there's been no home goods company at scale. There's been a lot of talks, and I've talked to other managers about it as well, that why not RH just be the home furnishings arm of one of these luxury brands? And then you almost kind of speculate, maybe down the road, RH gets acquired and they become the home furnishings arm of these small leather goods brands. And with the combined balance sheets, and if they still believe that Gary can get it done, fine, man. Get it done. Build it under the house of LVMH. Build under the house of, I mean, maybe not Hermes, but most likely LVMH, and go from there. So I think that's kind of where I see it. And that's a Hail Mary. That's like a 1% odds of that even happening, but it's still there. So that's kind of where I kind of see it today. And we'll see if anything changes.
Okay. And you've heard this one before. We ask it for basically every individual stock that we talk about on Chit Chat Money, is the pre-mortem to wrap things up. Why would a investment in RH go poorly? I know we talked a bit about some of this stuff already, but just to wrap things up, anything else that could concern you, you're watching as risks for this business?
Yeah, I think there's actually 3 core risks that I'm looking at. One, the economy does worsen, and it kind of just takes everybody down with it. It's not like RH is going to be isolated from it. It's not like other people are going to be isolated from it as well. It's going to hit the consumers hard. That's one thing. If that happens. Secondly, which I brought up briefly, but when you're trying to sell goods, you gotta sell goods that people want. And there's always the risk that these designers and these buyers don't necessarily buy the goods that people want to have in their home. If people are looking at the video of this, there's a lot of stuff going on in my background right now from Zoom that, like maybe people like it, maybe people don't like it. And if you're going to be stuck with that inventory, then yeah, you're going to take markdowns, you're going to take promotional hits to margin, et cetera. So there is that risk as well. And thirdly, like I said, the controlled call options, right? The new growth initiatives. If those don't work out, I would get concerned if Gary doesn't recognize that those aren't working out, in the sense of like he kind of, like I mentioned before, like doubles down or triples down on it, because we got to give it some more time. If they don't work out, no one holds options to expiration, right? You got to get out. You take the loss in this move. Or the flip side of that is like there might be hints that it could be working out, and you got to put even more cash into it. Then I'd be like, okay, is the return really there? We're just trying to like figure out, could it be there? I think those are probably like the 3 core ones. But the biggest one I have is just the overall economy. If this ship does not get right quickly, I think a lot of people are going to get hit with some collateral damage.
All right. Well, thank you again for coming on. Before we sign off here, where can investors find you? We're going to link to the Substack for anyone that it'll be in the show notes, but for anyone that just wants to search it, it is Cedar Grove Capital Management. But I'm giving the pitch for you. Where can the listeners find you?
Yeah, no. So I'm active on Twitter. So you can search by my name, and in the bio it has all the other places too. So I share my thoughts on Substack. You can find a lot of information there as well. And if you ever want to chat things, just shoot me a DM. They're open. Always happy to chat consumer and consumer tech. And just, trying to get new ideas and help people out and see what I'm missing.
Yeah, Paul is not wrong. His DMs are open, and he is very open to having conversations on Twitter. So definitely hop on if you're on Twitter. Definitely give him a follow, especially for these type of spaces. But let's hit the disclosure. We are not financial advisors. Anything that Ryan and I say on this episode or by guests is not formal advice or recommendation. We or our guests may own securities discussed in this podcast. Thank you, everyone, for tuning in, and we'll see you next time.